Super Microcomputer Inc. (SMCI) is currently trading at 29.66 USD, down 1.55 USD or 4.98% during this Thursday morning session on January 29, 2026. While a nearly 5% drop usually sends retail investors into a panic, the reality on the ground is that this is a high-stakes consolidation phase following one of the most intense regulatory turnarounds in recent tech history. Just 2 days ago, on January 27th, the company officially regained Nasdaq compliance, ending an 18-month nightmare of auditor resignations and internal probes. The expectation from the market was that a return to compliance would trigger an immediate, sustainable moonshot. The reality is that the compliance pop was sold into, and we are now seeing a tug-of-war between institutional relief and a cold, hard look at the company's shrinking margins. If you look at the recent action on popular investing sites, the volatility is off the charts, but the underlying narrative has shifted from "will they be delisted" to "can they actually make a profit in a price war?" Most people watching Nvidia stock or Tesla stock are used to high-flying valuations, but SMCI is currently a different beast. It is trading at a forward price-to-sales ratio of about 0.5, which is almost unheard of for a company tied so closely to the AI infrastructure boom. The general belief is that SMCI is a broken story because its gross margins have slipped into the single digits, specifically around 9.5%. The contrarian take, and the one forcing a rethink among professional traders, is that this margin compression is a strategic sacrifice to capture dominant market share in the liquid-cooled server space before Dell and HPE can catch up. The intraday movement today reflects a broader sector cooling, but for those managing an individual brokerage account or using a platform like SoFi Invest, the real story is in the volume. We aren't seeing the panicked high-volume dumping that characterized late 2024. Instead, we are seeing a steady absorption of shares near the 30 USD level. Institutional activity remains a massive piece of this puzzle. Recent 13F filings show that while some funds like Morgan Stanley trimmed their positions, heavyweights like Vanguard and BlackRock have actually been adding to their stakes. Even Goldman Sachs, which recently initiated coverage with a cautious sell rating, acknowledges that the revenue trajectory is still pointing toward a massive 2026. This disconnect between a sell rating and 100% year-over-year revenue growth is exactly where the tension between expectation and reality lives. For anyone involved in online investing, the technicals on SMCI are providing a masterclass in risk versus reward. The stock has spent the last few weeks carving out a floor. Every time it dips toward that 28 USD mark, buyers step in. This suggests that the smart money is treating these levels as a value play. If you're using a Fidelity trading platform or an Interactive Brokers account, you've likely noticed the high short interest still hovering around this name. That short interest acts like a coiled spring. Any positive surprise in the upcoming February 3rd earnings report could ignite a squeeze that would make the recent compliance rally look like a warm-up. Let's step back and look at what Supermicro actually does, because their business model is the only thing that justifies this kind of volatility. They aren't just assembling computers, they are the architects of the total IT solution for the AI age. Their edge lies in what they call building block architecture. While competitors might take months to design a new server around a fresh Nvidia chip, SMCI can do it in weeks. They are essentially the fast fashion of the data center world. Their current focus is on liquid cooling, a technology that is becoming mandatory as AI chips get hotter and more power-hungry. They currently claim a massive 70 to 80% share of the liquid-cooled server market. The expectation was that liquid cooling would be a niche. The reality is that it is becoming the industry standard, and SMCI is the only one with the manufacturing scale to meet the immediate demand of the AI factories being built globally. The history here is a roller coaster. We saw the stock peak near 120 USD split adjusted before the accounting scandal and the Hindenburg research report sent it into a tailspin. Many investors who bought in during that peak are still underwater, which creates overhead supply, a lot of people waiting to sell the moment they break even. This is why the stock feels heavy even when the news is good. However, for a new investor exploring self-investing or seeking investment help, the valuation today is fundamentally different than it was a year ago. We are no longer trading on pure hype. We are trading on a $36 billion revenue target for fiscal year 2026. As we look toward the next few months, the catalysts are clearly defined. First, the February earnings report needs to show that the internal control issues are truly in the rearview mirror. Second, we need to see if the $710 million in new credit facilities they secured for their Taiwan subsidiary is being used to ramp up production for the next generation of NVIDIA chips. If they can prove that their margins are stabilizing, even if they stay low, the market will likely re-rate the stock. The expectation is that margins will continue to bleed. If the reality is even a slight improvement to 11 or 12%, the stock could easily double from these levels to reach analyst price targets in the $50 to $60 range. Comment below how many shares of SMCI you are currently holding, or if you've moved your capital into more stable names like NVIDIA stock or even Schwab Intelligent portfolios. Do you think the management team has truly fixed the accounting issues, or is there another shoe left to drop? I want to hear your take on whether you trust a company that recently had to replace its entire auditing team. For those of you using a Fidelity brokerage or managing a Robinhood app portfolio, the play here is about conviction in the AI infrastructure cycle. If you believe the build-out of data centers is in its early stages, then SMCI is the high beta way to play that theme. It's riskier than a diversified Fidelity ETF or a basket of Fidelity mutual funds, but the upside is mathematically higher if they execute. The risk management strategy for an individual brokerage should involve tight stops because this stock doesn't just drift, it gaps. The broader macroeconomic environment is also playing a role. With interest rates shifting, the cost of carrying massive inventory, something SMCI has to do to stay fast, is becoming a headline issue. But they recently cleared a major hurdle by getting their financial house in order. That allows them to refocus on the engineering side. In the world of online investing, the compliance news was the signal that the existential threat is gone. Now we are back to a standard business execution story. In summary, the 4.98% drop today to 29.66 USD is a classic sell the news event following the compliance announcement. The central insight is that while the legal risks have faded, the execution risks are front and center. The contrast between the expectation of a quick recovery and the reality of a grinding, margin-pressured turnaround is what's keeping the price suppressed. However, with a forward PE that is now significantly lower than its peers like Dell or Arista, the valuation is starting to look like a spring that is being pushed down far too hard. Whether you are using SoFi Active Investing, Fidelity Wealth Management, or just trading fractional shares on a Robinhood Investments account, the next few weeks will be the ultimate test of the SMCI thesis. The volatility is the price of admission for a stock that sits at the very heart of the AI hardware revolution. The transition from a speculative, scandal-plagued ticker back to a legitimate infrastructure powerhouse is never a straight line. We are in the messy middle of that transition, but for those who can look past the 5% daily swings and focus on the fact that this company is still a primary partner for the biggest chip makers in the world, the price today represents a reality that is far more attractive than the market's nervous expectations suggest. Stay grounded, watch the margin data in the next report, and remember that in a gold rush, the people selling the shovels, or in this case the liquid-cooled racks, usually end up with the most gold in the long run. Would you like me to compare SMCI's current valuation metrics against Dell and HPE to see which one offers the better risk-adjusted entry right now? Disclaimer: this content is for informational purposes. It's not financial advice, so don't make any decisions without doing your own research or consulting a professional. If you found this helpful, don't forget to like, comment, and share. Stay smart with your money.